Shopify stock down around 16% after they reported their fourth quarter results, down looks like another 2% after hours. What's going on? As my subscribers at Unrivaled Investing know, I own a teaser position in Shopify, well under 1%. And I have a lot of teaser positions because I like to look at forward-thinking companies that have a lot of promise, and I wait to see when all the stars align, when I say, okay, you've got the execution, you've got the valuation, you've ideally got the cash flow going to shareholders. And when you get all those pieces and it lines up, then I say, okay, now I want to buy it. So this is why it's a teaser position for me. And now that I see it down, nearly 20%, I'm starting to think, okay, is this an opportunity for me to potentially back up the truck? Are they executing or are they not executing? And I should just keep it a teaser position, maybe not even, maybe blow out of it. So that's the goal of this video, to dive into, well, what is Shopify doing? How are they executing? What are my thoughts? What's the growth trajectory? What do I think of Shopify stock, let's say over the next 5 years? If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand what's going on with Shopify. You are watching Unrivaled Investing. So as I look at Shopify, look, this is a global e-commerce platform powering millions of merchants across 175 countries, 561 million unique online shoppers that are purchasing from Shopify merchants. When you think about all those shoppers, that is going to be a lot of data that can create a potentially competitive advantage. We'll talk about that in a second. They have 10% of US e-commerce market share. This is a signal to me. This number has been steadily going up over time, suggesting that they're taking market share, which is what I like to see. And they're doing a lot of the things that it takes to drive future growth. I like looking at forward-looking businesses where management says, hey, we're going to constantly invest in new initiatives to grow the business. That's what I want to see. And they're doing it in a somewhat intelligent way. For example, Shopify Point of Sales. This is to help their businesses not only have a strong online presence, but also to have a strong offline presence, meeting customers, meeting merchants where they're at. There's also Shopify Pay, effectively a payment gateway for merchants. Make it very easy to accept credit cards. Also makes it easier for the consumer. You don't have to reload your credit card information every time. Over 100 million different buyers have opted into Shopify Pay. This is growing quite quickly. And then once again, leveraging that 500 million plus unique buyers. Well, hey, if you know what the buyers want and you notice a pattern, some of these, with 500 million buyers, you're going to notice things. And you'd say, some of these buyers also bought this product. And you can then tell the different merchants, we have different customers that might be interested in your product based on their other intent over here. And so this could easily become a great advertising platform. And that's what they're starting to roll out with Shopify Audiences that's exclusive to Shopify Plus, their premium subscription offering to larger merchants. And so this is a very clever solution to sort of try to get a part of that advertising pie. This could be a very high margin revenue business over time. And they've also, once again, trying to address merchants' challenges, merchant pain points. Okay, well, merchants want to make sure that their customers get their products in a timely way. So in turn, Shopify is working with Flexport, a logistics firm, and they've also made recent acquisitions in Deliverr and Six River Systems to help ensure that they can offer Shopify Promise, where customers can get a package in a timely way. Maybe it's a day or two shipping. And this way they're saying, hey, yeah, we know Amazon has 1 day shipping or 2 day shipping. If you're a Prime customer, well, we're going to try to create something. And this is very early days, will cost them a ton to try to be able to create this promise for their merchants. There are hundreds of millions of merchants around the world. Now, when I look at their income statement, it's exciting to see, everything that management's investing in. But when I look at their income statement, I'm thinking management has missed the memo. The memo is that we are no longer in 2019, folks. We are in 2023. You have cash. It's yielding more than 4%. You go to Interactive Brokers. That's where I keep my investment accounts. Link below to Interactive Brokers. Yielding more than 4%. You have U.S. Treasuries, very short-term Treasuries, yielding nearly 5%. If you are a cash burn business, you need to have hyper growth to be compelling right now, in my opinion, because the alternative is a 5%, 4 to 5% cash yield. That is a real alternative that investors are going to increasingly turn to if you're not executing, if you're not delivering, and you need to prove out your profitability. And I look at what they're doing here, and it almost seems like they haven't gotten the memo. They've missed the memo on where the market is. So yes, they're delivering 26% growth. That's what I like to see, but it's not exactly where I want to see it, because subscription solutions, that's actually their really profitable part of their business. That's 75% gross margins. That was actually only growing 14%. Their payment business, effectively payment processing, that grew closer to 30%. This only has like 35% gross margins. So when you look at these two components, well, their gross profit only increased 15%. And given that these two different business lines have very different gross margin structures, investors are going to increasingly look at what's the growth in gross profit. And if it's not growing at hyper speeds, they're going to say, what's going on? And then when you look at how management is continuing to allocate their capital, and in this case, their operating expenses, and you see that R&D jumped 60%. General and admin was up over 100%. This was because of a one-time impairment from real estate. Part of this is probably work from home challenges and things like that. But still, like, this is a huge increase in operating expenses. I mean, for example, with R&D, management said, yeah, we needed to adjust. A lot of our employees weren't getting paid enough, so we raised salaries. Like, they're not getting the memo. There's layoffs going on, and you're saying, oh, we're also going to, and they've done their fair share of layoffs too, but maybe it's not enough. And for them to say, okay, we'll do layoffs, and then we're also increase, the pay here, I don't think they get it. Like, they need to be profitable ASAP to be super compelling, in my opinion, for a lot of investors out there when they're facing, a 4 or 5% yield on short-term vehicles. And for them to be posting a $200 million operating loss. And by the way, it's even worse when you look at their full income statement, which includes losses on their investments, changes in the market value. So I just think management hasn't gotten the memo yet on really getting to profitability. So okay, what's this mean for Shopify stock? Where do I think it goes from here? Well, Unrivaled Investing is dedicated to helping everyday savers become better investors. Subscribers receive investment insights, compelling ideas, and my personal real-time portfolio updates. We also have an active community on our exclusive Discord server, available only for our annual subscribers. I also recently launched 2 new investment courses for enterprising investors that want to understand how to value stocks. That's where a lot of folks got burned, and also how to read financial statements. So that's my quick plug. And full disclosure, this is not financial advice. I do own a teaser position in Shopify stock. So how should you think about where Shopify goes from here? Well, first of all, management provided some guidance for where they think the business is going during the first quarter of 2023, and they're guiding to a high teens percentage growth. That is also definitely not what management, this is not what Wall Street wants to hear. Wall Street does not want to hear a highly unprofitable business only growing at a high teens rate, especially when it means your gross margins is probably low teens. And then they talk about, well, there's pressures, because of inflation and the consumer struggling to spend on discretionary goods. They're talking about continued dilution from their investments in their fulfillment network, how there's compensation structure changes. So you're going to continue to see their operating expenses, elevated, and they're investing in some of these growth drivers. So, you're not going to get necessarily profitability in the next few quarters, maybe longer term. And, so you see that. But then you also have to combine, sort of balance this perspective with the fact that management is raising the price for their various different plans because they know merchants, find it to be incredible value. And this is part of the reason why I own a teaser position, is because when you see something that's really compelling from a merchant perspective, from the merchant perspective, say, hey, we're going to stick with Shopify, even if you raise prices 10, 20, 30%, that is interesting to me, seeing that sort of pricing power. Now, I'm very curious to see how it actually affects their results this year. How much does it accelerate their business? What's sort of the churn? I suspect they will be able to handle this price increase because they've done a very sizable price increase that will go into effect later this year. So you won't see that impact the first quarter. That's more of a second quarter and the rest of the year results. Now, how do I think about the valuation of where Shopify goes over the let's say the next 5 years? This is my hypothetical valuation framework. If they deliver way better than what I'm penciling out here, of course the stock price could go way higher. But if they don't, or if they just deliver what I'm penciling out here, I think shareholders could be disappointed. And that's really what I'm getting back to when I'm looking at this, is you still have a business that's hugely unprofitable, still at over a $50 billion market cap. And even if you assume that profit margins get to 20% over the next few years, once again, hugely unprofitable right now, only a 15% tax rate. So I'm trying to give them all the benefit of the doubt. you're still effectively looking at a business that on a forward multiple would trade at like around 50 times earnings. And keep in mind, they're only guiding to high teens growth. I'm giving them even more benefit of the doubt. I'm saying 20 to 30% growth because you have these price increases in their plans. The truth is, I still don't really think that's going to happen, this 25, 30% growth. Hey, maybe they accelerate it, because keep in mind, the price increases only is tied to their subscription revenue, not their merchant processing revenue. So either way, I'm trying to give the benefit of the doubt to understand what shareholders see right here. And then I look at like, okay, over the next 5 years, maybe they keep growing at around 20%. If this is wrong, and if it's much higher, then I think the stock price could go way higher. But I'm trying to be conservative. I'm trying to be reasonable, say, hey, based on the data I'm seeing now, let's assume 20% annualized growth in the years ahead. And I'm assuming around 20, 25 times earnings multiple 5 years from now. And this gets honestly a pretty ugly price return over the next 5 years. Like, this is not compelling. Effectively upside of 40%, downside of 30% over 5 years. That's really ugly. So this gets back to my point earlier. Growth is wonderful. Growth is what every investor wants to find. You want to find growing and compelling investments. You want to find businesses that have proven that they can grow over a multi-year, multi-decade perspective. That's important. One of my top positions is an insurance company that's proven that they can compound for decades at a mid-teens to high-teens rate. That's what I like to see. You've proven that you can grow. Shopify has proven that they can grow. But you also need to have that valuation. You also need to have compelling financials. And they're not there yet. They haven't delivered on that. Now, management might say, well, look, we've historically been profitable. That's a bunch of hooey, because when they say we've historically been profitable all these past years, they're adding back stock-based compensation, which is nonsense. That's diluting shareholders each year. And they continue to do that in their financials. Oh, let's add back stock-based comp. They have missed the memo of where we are today versus where the market was previously. And so I look at this, and given that management doesn't seem to really grip the reality of where we are right now, I'm not inclined to scale it up. If anything, I'm inclined to cut it, even though it's a teeny tiny position for me. I think looking at this, the execution isn't there. And I personally wouldn't be surprised if this has a similar playbook to how Amazon traded after the .com implosion, where Amazon fell like 90%, similar to what you're seeing with Shopify. It wouldn't surprise me, just like Amazon did, that it trades in a range for years. So just like how Shopify, was trading, let's say mid-20s just a few months ago, would not surprise me to see Shopify go back there based on these results. That's my personal expectation. I own a teaser position. I am personally not going to be scaling it up based on the execution and how management seems detached from the realities of the current marketplace, which needs to see profitability and the recognition. Look, 4 or 5% rates that investors can get. You need to either be posting hyper growth, 20 to 30% real growth outlook with an attractive free cash flow profile, hopefully coming soon. And they're still at a cash burn state despite having tons of stock-based compensation. I think there are just better plays out there, companies that have already proven themselves, and you can get the valuation. I call out the ideas that I personally am buying to my subscribers at unrivaledinvesting.com. If you enjoyed this video talking about Shopify, please make a point of hitting that subscribe button. Thanks so much for watching Unrivaled Investing.